We go to chapter 21, limited companies. So when we talk about limited companies, we're talking about companies that have a separate legal entity or legal identity from their owners. All right, so scroll down. Introduction. A limited company is a legal entity which has a separate identity from its shareholders, whose liability for the company's debt is limited. So we call it a limited company because the owners, they have a separate, the owners, and that means the shareholders or the investors have a separate legal identity from the business itself. So that means the business can sue or be sued. The business can have its own contract with anybody or any other business. Do you understand? So that's what it means. And whatever debt that the business owes, it does not affect the personal wealth of the owners of the business. The owners of the business might lose their investment, but they would not lose anything that is not attached to that business, to the business, in case there's a debt of the business. So they say sometimes a new business is formed as a limited company. Sometimes a limited company is formed when a sole trader or partnership wishes to expand their business. So there are two ways in which we can form a limited company. You can form a limited company by starting up a new business, or an existing business like a sole trader or partnership coming, trying to expand and becoming either a private limited company or a public limited company. So go to the nature of a limited company. One person acting alone can form a limited company, and there's no maximum number of members. The capital of company is divided into units known as shares, which can be of any monetary amount. The member shareholders of the company are only liable for the debt of the company up to the amount they agree to pay for their shares. Since the company can have a large number of members whose liability is limited, a large amount of capital can be raised. The shares of a company have a face value, that's per value, such as $5 and stores. Profits are distributed among the members in the form of dividends, which are often stated in terms of the percentage of the face value of the shares. So this is the nature of a limited company. We call it a limited company because there's no minimum number of people that can start it. Two, the amount involved is unlimited. Anybody can contribute any amount it wants, but in terms of shares. So you have to buy shares to contribute capital into the limited company. The share profit based through in dividends. That's how they share profit. They don't lose their personal wealth when the company is running at a loss. The only thing you lose is what you have put into the business in terms of the value of the shares that you put into the business. I think that is clear.
Yeah.
Then that's limited has a total capital of 200,000 shares of $2 each, and decided to pay the shareholders of dividends. And decided to pay the shareholders a dividend of 10%. What is the total amount payable? So that's has a total capital of 200,000 shares for 2,000 each, and decided to pay shareholders a dividend of 10%. So the total amount payable is, we calculate 200,000 multiplied by 2,000. That's 400,000. So 10% of 400,000 is 40,000. So do you get it?
Yes.
Then what is the amount payable per share? They said each year will have dividends of 100,000 shares of 2 each, and decide to pay shareholders a dividend of 10%. So the dividend of 10% of the amount of the shares. Do you get it? They are paying dividend of 10%. So what's the value of the share? The value of the share is $2. So 10% of $2 is what each person will get.
Yes.
Do you get it?
Yes.
Okay. So there are two types of limited company: the public limited company, which may offer its shares to the public, and the private limited company, which is usually a smaller company and is not allowed to offer its shares to the public. So we have two types of companies. We have public limited company and private limited company. The public limited company, they are not allowed. The public limited companies can sell shares to anybody because they can trade their stock in the stock, or they can trade their shares in the stock exchange market. But for private limited company, they are not. They are private limited. Their shares is restricted to families and friends. Family and friends.
Yes.
From the viewpoint of the individual, the main benefit of being a member of a limited company is the fact that the liability for the debts of the company is limited to the amount the member agreed to contribute. It's also beneficial that a limited company has a separate legal entity to its shareholders. So legal actions are taken against the company, not the individual shareholders. So when it comes to the debts of the business, the only thing you lose as a shareholder is the amount of money you put into the business in terms of your share, the share capital. And because the business has a legal separate identity, so that means if the company is sued, if there's a lawsuit against the company, it does not affect the business.
What's that?
You don't get it?
No.
We said, from the viewpoint of the individual, the main benefit of being a member of a limited company is the fact that the liability for the debts of the company is limited to the amount members have agreed to contribute. That means the only thing you lose is the amount of money you've contributed when you are buying the shares.
Yes.
The second point is about a separate legal entity. Because the business is a separate legal entity, it means whatever happens to the business is not transferable to the owner of the business. So if there's a lawsuit, like if there's a case that the company has to answer to, it's not going to affect the owners of the business. It's not going to affect the shareholders.
So affect the person that they
It, when there is a court case,
yeah.
it's not going to affect. The court case is not against the shareholders, rather it's against the business. So it does not affect the owners of the business.
So to affect this internal stakeholders without the owners. I mean the consumers. Not the consumers, the employees.
Though, yeah, it could affect them, but what we are saying is when there's a debt that has to be paid,
yes,
it has to be paid through the company, not shareholders.
Yes.
So maybe the business is, if the business is unable to pay its debts, the business might go into bankruptcy. At that point in time, the business has to sell all its assets to fund or to pay back the debts. So that's what they are saying there. It is also beneficial. Okay, yeah. Apart from very small limited companies, it is not usually practical for shareholders to take an active part in the running of a business. So a board of directors is appointed to run the business on a daily basis. If shares are held in a public limited company, it is easy to buy and sell shares. In a public limited company, the shareholders are not those that run the business. Those that run the business like directors are elected by the board of directors or by the owners of the business. They are elected to rule. Unlike private limited company, that all the members are actively involved in the business. So for public limited company, you might not be actively involved. It doesn't matter. That's the point they are making. The directors run the business, and you can appoint the directors as owners of the business. Is it clear?
Yes.
Then, because it's a public limited company, you can sell the shares. Nobody has authority over your shares. You can sell it to whoever you want to sell it to. Is it clear?
Yes.
From the viewpoint of the business, being a limited company means that it is possible to access greater capital than it's possible for a sole trader or partnership business. Loans can often be obtained more easily by a limited company than by a sole trader or a partnership business. A company has continuity of existence. A company has a continuity of existence, unlike a sole trader or a partnership business. However, there are many legal requirements in relation to forming and running a limited company, and annual financial statement was prepared and provided by shareholders. So what they are saying is this: the last paragraph is talking about the viewpoint of the business. If the business is being considered as a limited company, which means because the company is a limited company, it has accessibility to large amount of money in terms of capital, share capital. Because you can sell your shares to the public. So selling your shares to the public will generate more money for the business. The second point I made there is about continuity of existence. Continuity of existence. Companies do not go down when one of the shareholders die. No, the company continues to live on, isn't it?
Yes.
The death of a shareholder would not stop the operations. You get the point?
Yes.
So, but what happens to share, or what happens to shoemaker? What happens to sole traders and partnership? Because as a sole trader or partnership, especially for sole traders, but even for the partnership, if for the sole trader, if the owner of the business dies, the business is entirely gone. Even if someone is taking over that business, maybe the son is taking over, the son will change a lot of things. He will change it to his name. So, a sole trader it means the risk involved being a sole trader is not the same as being in a private limited company. You get the point there?
Yes.
All right. So and the last thing they talked about here is legal requirements for sole traders or partnership, whatever it is. They don't need documents that has to be taken to the registrar of companies. Do you understand? Sole trader can start his business here without any issue. Partners, they could come up with what we call the partnership deed or deed of partnership. That's an agreement that is binding the operations of the partners. They can come up with that. But they are not in charge of the economy. You get what I'm saying? They can come up with these things, but whoever is in charge, it does not affect them. For limited companies, no, limited companies are owned by private individuals coming together to start the business. Public limited companies are the same, public. But for sole traders and partnership, they don't have to give accounts, financial records to the public. They don't have to do that. For partnership, they can come up with deed of partnership, which guides or which regulates the affairs of the partnership. Nothing more, nothing less. And it could be signed by the lawyer or whoever it is, but it's not a document that the government needs to know about. So that is the point they are making there. So for sure, I think it's clear. The company will continue to exist even with the death of one shareholder or two. Sole trader would not. As the owner of the business dies, the business is gone. Partners, when one partner dies, maybe the family or whoever it is might need to take its contribution. So the partnership business might be off. Is it clear? Now we go to share capital. So we're talking about share capital. We're talking about the amount of money that will be raised from the sales of shares. The amount of money that will be raised from the sales of shares is called share capital. So let's say when a limited company is formed, the amount of share capital required will be issued to the shareholders. And this is known as the issued share capital. If more capital is required at a later date, further shares can be issued. So a company may not immediately require all the money due on the shares it issues. In this case, shareholders may be allowed to pay in installments at times, an amount fixed by the company. The total amount the company has requested from the shareholder is known as the called up capital. So look at the point. It says a company may not immediately require all the money due to the shares at issues. In this case, shareholders may be allowed to pay in instrumental time at times or an amount fixed by the company. So you could become a shareholder by not even paying at once. You could pay on instrumental, that means bit by bit, but you have the ownership of the shares. I think that is clear. So we go to the called up capital. So this is the amount of money, or this is the amount a company has requested from the shareholders. That's what we call called up capital. So the amount of money, this company wants to sell shares worth of $500,000. So we are expecting potential investors or potential shareholders or existing shareholders to buy certain amount of shares. So that amount is being called up capital. Just how called up capital is here.
Yes.
That's the amount requested by shareholders to pay for that shares. I think it's clear.
Yes.
They'll go to paid up capital. They said the term paid up capital refers to that part of the called up capital for which a company has actually received cash from its shareholders. The term paid up capital refers to that part of the capital called up capital for which a company has actually received. We have called up capital, which is what we are thinking we should get from our customer or from our potential investors or shareholders. Then we have the paid up capital, which is part of the called up capital, which means, out of the called up capital, our called up capital is $500,000, but 300,000 have been paid. 300,000 shares has been bought. So the worth of shares paid, or the worth of paid up capital is what 300,000. Do you understand what paid up capital now?
Yes.
The amount that has been sold in that by the shareholders.
Sure.
That's paid up capital. So we'll go here. I said Visual Limited was formed on 1 January 28. A total of 300,000 for $1 share were issued immediately, and shareholders were asked to pay 50% of the sum due immediately and other 50% in January 29. So by May 128, holders of the 290 shares had paid the amount due. State the issued capital for mutual. So what's the issued capital? They said the total of shares is 300,000 for $1. So the total share issue is $300,000. I think it's clear.
Yes.
Now they said we are issued immediately, and shareholders were asked to pay 50% of the sum due. So 50% of the sum due is 50% of 300,000, which would be our called up capital.
Yes.
Listen, please. What you have to understand here is what is called up, what is issued capital, and what is paid up capital. Issued capital is the total amount of shares that the business or the company is about to sell. Called up capital is the amount the business is expecting shareholders or potential shareholders to pay. Paid up capital is the amount paid by the shareholders after the called up capital.
Yes.
So the issued capital is 300,000. The called up capital.
Yeah, 150.
Yeah, how is it 150? It's a 50% of 300,000, which is 150,000. Then we have the paid up capital. They said by May 128, holders of 290,000 shares had paid the amount due. So 290,000, 50% of it is they said 50% of the sum due immediately and other 50%. So 50% should be 50% of paid up capital should be paid, which is so paid up capital is the amount paid, right?
Yes.
So they said 50%. So 50% of paid up capital. So it's 145,000, which is 290,000 shares. Is it clear or not?
Wait, you get 145. Must be 150.
How is it? Is it not 290 paid? On May 28, holders of 290,000 shares had paid the amount due. 290 multiplied by 1 is 290,000.
5 is 0.5.
290,000 multiplied by 1, because each share is $1. So you have to multiply each share with the share issue, the value of the face value of the share. So it's 290,000 multiplied by 1, because the price of the share is 1. Please don't forget that, because the price might be 1.5, might be 2.5. So don't just go and write the same figure.
But it won't give you 145 your time. 290 times 1 is not
290 times 1 is 290,000. But they said 50%.
9%.
The called up is 50, the paid up is 50%. Is it clear now?
Yes, yes.
So go to types of shares. The share capital of a limited company may be divided into different types of shares. The common one are preference shares and ordinary shares. So what are preference shares? As the name implies, this get preferences over the ordinary shares. They receive a fixed rate of dividends based on the face value of the shares. which is payable before any dividend is payable to the ordinary shareholders. The dividend is the same every year, provided that the profit of the company is enough to cover this amount. If a company is wound up or closed down, any money left after paying outside liabilities is used to pay back the preference shareholders before anything is returned to the ordinary shareholders. Preference shareholders are not usually entitled to vote at shareholders meeting. So for preference shares, they are just investors. So they are not the owners of the business. So the only thing they lose is the amount of shares they bought in the business. So what are the features of preference shareholders? For preference shareholders, one, their rate of dividend is fixed. Two, they have to be paid dividends ahead of ordinary shareholders. If the business is winding down or winding up, sorry, if the business is winding up, that means closing down. As soon as the liabilities are paid, the rest of the money has to be shared as dividends, even before the ordinary of shareholders get their own percentage. Is it clear?
Yes.
Sure.
Yes.
That's preference shareholders. So here they said there are several types of preference shareholders. The most of these are outside the scope of this book. However, it is necessary to understand the difference between redeemable and non-redeemable preference shares, as this affects the treatment of dividends and how the shares appear in the statement of financial position. If the preference shares are redeemable, the dividends is included as finance cost in the profit and loss section of the income statement. The preference shares are shown as current liability in the statement of financial position if it is non-redeemable. Look at it. In our income statement, in the profit and loss section, we have what we call the finance cost. It's part of our expenses.
You can just financial.
No.
Income.
Income statement, profit and loss section.
Yes.
We call it finance cost. It's the amount of preference shares we have to pay. Do you understand?
Finance cost.
Yeah. But it should be redeemable shares.
What is that?
That means those shares that you have to pay their dividends. You get what I'm saying? Dividends have to be paid, right?
Yes.
So these dividends that have to be paid are for preference shareholders who have redeemable shares, So we call them redeemable shares because these shares can be bought back by the business.
Yes.
They are non-redeemable, they are redeemable. Non-redeemable shares goes to your statement of financial position because it cannot come back to the business.
Yes.
But redeemable shares are shares that the business can buy back. So it becomes a cost for the business. You get it or not?
Yes.
For preference shareholders, they need to get their dividends. And they get their dividends even before the ordinary shareholders. Their rate of interest is fixed, in as much as the company is making profit to cover for its expenses too. For preference shareholders, they are not. I'm telling you the features of preference shareholders. The first thing about preference shareholders is that they are not the owners of the business. They are just investors they are just shareholders in the business. What they would lose in the business is the value of the shares they bought. Also, when it comes to voting rights, they are not allowed to vote in the annual general meeting. During the AGM, preference shareholders cannot vote. For preference shareholders, they get their dividends before anybody else. If the business is closing down, as soon as the business pays for its liabilities, the next thing the business has to do is to pay the rate of dividends for those preference shareholders. Now, we have two types of preference shareholders. We have redeemable preference shareholders and non-redeemable preference shareholders. So why do we call them redeemable preference shareholders or redeemable preference shares? We call it redeemable preference shares because these shares can be bought back by the business at a fixed period of time. So as soon as the shares are sold, it will be agreed that the company can buy it back at a given date and at an agreed price. That's what we call redeemable preference share. So when you how do you now post this? You post it in your income statement, profit and loss section as finance cost. Why is it finance cost? It is finance cost because you are buying something like assets back to the business. Did you get it?
Yes.
So we have finance costs, we have finance income. So for redeemable shares, you are buying shares back you are buying it back from those who own it, right? What happens? It becomes part of your capital, but you are paying for it. So that's why it will be recorded in your income statement. But for non-redeemable shares, non-redeemable preference shares, it is recorded in the liability. It's a current liability. Yes. Do you understand why? Because it does not belong to you anymore. It belongs to the shareholders. I think it's clear.
Yes.
All right. So then we go to ordinary shares. Ordinary shares, they said these are also known as equity shares. Dividends are ordinary shares. The dividend on ordinary shares is only payable after that on the preference shares are being accounted for. Dividend is not a fixed amount, but can vary according to the profits of the company. If the trading results are poor, and the ordinary shareholders if the trading results are poor, the ordinary shareholders may receive no dividends at all. But if trading results are good, they may be awarded high dividends. If the company is wound up, the outside liabilities and the private shareholders are repaid before any monies are returned to the ordinary shareholders. This may result in very little being returned to the ordinary shareholders. If the company was short of funds, however, the ordinary shareholders may receive a return higher than their original capital investment if the company had adequate funds. Ordinary shareholders are usually entitled to vote at shareholders meeting on the basis of one vote per share. So for ordinary shareholders, they are basically the owners of the business. Their shares have value. So what happens with them? What are the features of ordinary shareholders? One, they have the right to vote in the annual general meeting, which means that they have one vote per share in the annual general meeting. They can vote. Two, when the business is making huge profit, they might be entitled to higher dividends. When the business is making huge profit,
they can make that.
Yeah, because their own rate of dividend is not fixed. Unlike preference shareholders, they have fixed rate of interest. So whatever happens, even if the business is making more profit, they will still get the fixed rate, but they get it ahead of ordinary shareholders. So ordinary shareholders, the risk being an ordinary shareholder is higher than the risk being a preference shareholder. Ordinary shareholders might not be able to get dividends if the dividend is not enough to reach round.
But it might be a benefit if
if the business is doing well. Yeah. So do you understand? So one, ordinary shareholders have more risk than preference shareholders. Two, they don't have a fixed rate of dividends, which means that whatever happens, if the dividend rate, if the profit made in the business is less, they would get less. If the profit made in the business is high, as soon as the other preference shareholders are paid, as soon as the liabilities of the business is paid, then they might be getting a higher pay.
Can you give an example, like for preference and ordinary?
We just talked about the profit made. If profit is, listen, if the company, let's say the company closes down. If a company closes down, if a company is declared bankrupt, let's say the company becomes liquidated. If the company becomes liquidated, it means the business has to sell its assets to pay off its debts. As soon as those debts are paid, the next thing is to pay the dividends of ordinary shareholders or preference shareholders. So if what is left is 500,000, for example, and it is the rate of interest or the rate of dividends is 5% for each shares, and maybe the shares is $10 each. So that means 5% of $10. Do you understand? Is what each shareholders will get. So that means if you have share worth of $500, as soon as 5% is being divided by the $10, then multiplied by 500 worth of shares you have. So they have to pay all preference shareholders. Whatever is left is what will be shared among ordinary shareholders. Because ordinary shareholders are basically the owners of the business. They have equity because they own equity, they have equity shares, which is capital. So they are the owner, they have share of equity, they have equity share. So the business belongs to them. So whatever is going to happen, they take more risk than private shareholders. So if the business is making more profit, they get high profit than private shareholders.
Yes, I get it.
So for ordinary shareholders, they are also entitled to vote during annual general meeting. They don't have fixed rate of dividends. If the profit is low, they get less. If the profit is so high, they get more. What else again? They don't have fixed amount of dividends and they can vote in annual general meeting. They said that already. So this is all about ordinary shareholders. Any question about that?
No.
So we'll go to equity. I'll go to debentures. So debentures. They said, in addition to the funds provided by the owners, a company may also obtain funds from debentures, which are long-term loans. So for debentures, here we're talking about you getting a long-term loan from people, like from companies, from investment firms. You get a debenture from them. So this amount there's a fixed rate of interest on it. For debentures, it's a long-term loan. A business, this is a business, right? A business can raise capital through selling of preference shares. A business can raise capital through selling of ordinary shares. A business can also raise capital through getting loans. So the form of loan they could get a debenture.
How does it work?
What?
How does it work?
A loan, normal loan.
Like, yeah. A loan, like they take a loan.
They take loan from investment companies.
Oh, yeah.
Like,
Yes.
do you get it now?
Yes.
So they take loans, it's a long-term loan, which is fixed in terms of interest,
yes,
and has to be paid. The business is making profit or not making profit, it's not the problem of the venture holders. They have to pay.
They have a certain time to pay.
Yeah, they have to pay.
A loan,
yeah. Okay, so like most loans, the ventures carry a fixed rate of interest, which is payable whether or not the company makes profit. This loan interest appears at a finance cost in the profit and loss section of the income statement. If the company is wound up, the debenture holders will be repaid before any capital is repaid to shareholders. The debenture holders are not members of the company and so are not entitled to vote at shareholders meeting. The difference between ordinary loans, like different kinds of loans, and debenture is that for debentures, it has a fixed rate of interest. So if the interest rate is increasing, it does not affect debenture holders. If the interest rate is falling, it does not affect debenture holders.
It's fixed, right?
Because it is fixed.
Yes.
Do you get it?
Yes.
So, and when the interest on this loan, we put it the same as finance cost in the income statement.
The expenses.
Yeah, it's expenses, but as finance cost. The ventures holders, they are not owners of the business. They are not members of the business. They are just someone who has given money out, expecting his money from the business within a fixed period of time with interest. So go to income statement of a limited company. All right. So income statement of a limited company. They say an annual income statement is prepared for a limited company in exactly the same way as it's prepared for a sole trader or partnership. The only difference is that in the finance cost, there may be debenture interest and dividends on redeemable preference shares. So the difference between the income statement of an unlimited liability company like sole trader or partnership and the limited liability company is that for the limited liability company, we could have finance costs such as debentures, such as redeemable preference shares. Clear?
Yes.
Statement of changes in equity. He said, this statement, okay, how it was necessary to prepare a profit and loss appropriation account for partnership business to show how the profit was divided between the partners. In a similar way, a limited company must prepare a statement showing how the profit for the year is used. This statement is known as statement of changes in equity. It summarizes the changes during the year to the ordinary share capital, non-redeemable preference shares, capital, retained earnings, and general reserve. So it has already been estimated that profit are distributed to the shareholders of a limited company in the form of dividends, which we know, an ordinary share dividend, and any dividend on non-redeemable preference shares, which has actually been paid during the financial year, is recorded in the statement of changes in equity for the particular year. So, ordinary shareholder dividends that has been paid, if there's any, and dividends on non-redeemable shares, they have to go to your statement of equity, changes of equity.
Ordinary shares and non-redeemable.
They have to go to your statement of equity.
Yes.
I think that is the point there. So sometimes the directors will recommend an interim dividend, halfway dividend, to be paid during the year on ordinary shares and also on non-redeemable preference shares. This will appear in the statement of changes in equity for the particular year. Okay. So at the end of each financial year, the director of the company proposes that ordinary share dividends and possibly dividends and non-redeemable preference shares are paid, and these will be paid early in the following year. So these proposed dividends are not included in the statement of in the financial statement for the current year, or may appear as a note. They are included in the statement of changes in equity in the year in which they are actually paid. Very often, limited companies do not distribute the whole of the profit for the year as dividends. Even if a limited company wishes to distribute the whole profit, it would not be possible if there was not enough cash available. So any profit that is not appropriated for dividends is carried forward to the following year. This is known as retained earnings and will appear in the equity and reserve section of the statement of financial position. Let me quickly talk about that before we go to the next paragraph. For who takes decision about shares, dividends, and retained earnings? The directors of the companies. So the directors of the company didn't feel that this year they have to pay ordinary shareholders dividends. It would have been as a result of the profit made by the business. So ordinary shareholders will get what percentage they have to get with immediate effect. But if it is decided that profit should not be shared in that financial year, then nobody gets the profit. It will be paid in the next financial year. But these things have to be backed up by the board of directors. They all have to accept it. Do you get it?
Yes.
So directors will decide if they have to pay dividends to ordinary shareholders, or they have to put that money back into the business as retained profit. Clear, right? Or retained earnings is the same. It's the same as retained profit.
Yes.
So in addition to leaving a balance of retained earnings, many companies will transfer an amount from the profit for the year to general reserve. This is another means of plowing back profits to the company to help it grow.
The three have the same meaning. Are you plowing back profit is like the same as retained profit, retained earnings?
No, when general reserve is where you can put those amount of money the business doesn't want to use right now. You put it in the general reserve until it's ready to be used.
And plowing back.
Remember, putting back, plowing back profit, and bringing back profit like retained earnings.
Yeah, I told you.
Yeah, listen, what they are saying is that maybe now they don't want to declare profit. If they don't want to declare profit, they'll put it in general reserve. Sometimes the business might feel like it's not the right time to declare profit. So we're not going to declare, because as soon as they declare profit, shareholders have to get what they have to get. Government have to get what they have to get in terms of taxes. Sometimes it might take a long period of time. They will not. You get it?
Yes.
So here we have, it said Anna Limited was formed on July 1, 2023. By 30 June 26, a total of 200,005% redeemable preference shares of 1,000 each as and 60,000 shares of 0.50 each have been issued and they are fully paid. So they are all paid up capital. The following information is provided. The profit for the year ended before the preference share dividend was 58,000. On July 1, 2025, she retained earnings brought forward amount to $41,000. And then reserve amount to 45,000. Half of preference share dividends was paid on 31/25. On 30 June 26, the remaining preference share dividends was outstanding. We have outstanding there. The proposed final ordinary share dividends of 30,000 for the year ended. That's called up capital. A year was paid on 30th of June. An interim dividend of 24,000 was paid on 31st of June.
That's paid up.
Yeah. On 30 June 26, other directors recommended a transfer of 8,000 to the general reserve and payments. And yeah. And the payment of another share dividends of 8%. Now we said we should prepare changes of equity for Anna Limited. So when you have to prepare changes of equity, so we have items like we have the ordinary share capital, we have the general reserve, we have our retained earnings. Those are the things we have. So your ordinary share capital plus general reserve plus retained earnings will give you a total. So let's look at it now. We start at one at a time. There's a balance, which is they said shares will be sold at for $300. Said 200 600 ordinary shares. For ordinary shares, we have 600 ordinary shares at 0.5. So the ordinary share value is $300,000. That's 600,000 multiplied by 0.5.
Yes.
So the value of ordinary shares is 300,000. I think it's clear. Yes. That is the only thing in share of capital for general.
They said the amount
for ordinary shares, yeah.
The amount they reserved is 45,000, which is the general reserve.
So for general reserve is we check if there's any general reserve there.
Yeah. On second one, on 1st July 2025, they retained earning profit forward amounted to 41,000.
45,000, yeah, reserve. So our general reserve is 45,000, done. Then we go back to our retained earnings.
Yeah, 41.
Yeah, the retained earnings is 41,000. All right. So now for the retained earnings is done. They said they have profit for the year.
Yes.
You get it on 48,000. We have what we have to work on is we have to work on our dividend paid, our interim dividend, and transfer to general reserve. Okay. So our dividend paid. They said check the additional information, please. Retained earnings brought forward amounted to 41,000, and the general reserve amounted to 45,000. So we have retained earnings brought forward for 41,000. That is done. The general reserve is 45,000. That is done. Then we have profit for the year, which is 58,000.
So the profit for the year is 58 was reduced by reference here.
They said the profit for the year ended before the preference share divided was 58,000. Before. So what is the preference shares? The preference shares are divided as
preference shares is 200, 5% of one.
Let me see. Where's the calculator? Where's your calculator?
Hmm?
Your calculator, please. Okay, thank you. We have
200 total. And 5 redeemable.
5% redeemable preference shares.
Yeah,
We
of
talked about that.
one.
That's 300,000 for 9 shares. That's done. No, 200 for redeemable shares, right?
Yeah.
So, and 5% should be paid. So 5% of
5% and $1 each. The first
200,000 for 5% redeemable preference shares. 200,000 as 1,005.
So what are you to do? 205, 200,000 times or
Yeah, it should be 200,000.
times 1.
200,000. They said a total of 200,000 redeemable, 200,000 5% redeemable preference shares of $1 each. So it is 200,000. The worth of the shares is 200,000.
Yes. What's the calculation?
So that's 100,000.
Hmm?
That would be 100,000 for redeemable preference shares. 100,000 minus the amount 58,000. For preference shares, 58,000
Yeah, before dividends.
before dividends. Okay. And what's the value of the dividend paid?
Yeah.
I said half of the preference share dividend was paid on 30th of June. Half is paid on 30th of June. And have to be paid later on.
Where is it?
In the additional information, they paid half.
Hmm.
They paid half, which is that's 30,000. Five percent of they said the proposed final ordinary share dividend of 30,000 for each year ended on 31st of June 25 was paid on 30 of this.
Mhm.
So we have 30,000 paid for preference shares.
Yes.
So dividend paid 30,000 paid first time and 30,000 paid. 30,000 is paid for the first time for dividend. That's what they paid.
We need to get 10,000 because they said that profit for the year of is 58,000 was reduced by reference to share dividends for the year of 10,000.
Listen, what we need here, we need our retained earnings.
Hmm.
Why do we need all the retained earnings are what we are getting back, what we're going to pay out to our shareholders. These are our retained earnings. So the first one is the balance, which is 41,000. Then we have the 48,000, which was paid.
40, no. We don't get this.
Look at it here. They said the profit for the year. The profit for the year.
Yes, 248.
The general, I don't know, 600, 0.5 of this is done. The profit for the year before the payment share divided was 58,000. Before
No,
the payment
it's
share
before.
was divided.
Yeah.
So what is the payment share? The value of the payment share is 0.5 multiplied by 100,000.
100.
200,000 multiplied by 5%, which is what? That's 100,000, right?
No.
What is 5% of 200,000?
10,000.
10,000.
Yes, 50% is 100. 10% is 5.
10,000, right?
Yes.
So before, right?
Oh, yeah, I get.
So it will be 58,000 minus the 10,000.
Yes. That's not it. Because you were saying 5% of to 200 that I was, yeah.
Yeah, it's 5% of the.
Yeah.
Yeah, it's 5%.
Times the value of the share.
5% multiplied by 200,000 is 10,000.
Multiply by 1 before each.
Yeah, it's still gonna be 10,000.
Yes.
So you take it away from the 58,000.
We'll give you 48, which is the profit for the year.
That's the profit for the year.
Yes.
Because at that point in time, you paid shareholders. So that's 48,000. And they said dividend paid. They paid final dividends for 30,000.
Yeah.
30,000. You add it. You add your profit for the year, the balance. You less dividend paid. from those profits.
Final and interim.
Interim, yes. Final and interim, you add them together. Interim is 24,000. Interim is 24,000.
Yes.
Final is 24,000. You add them together, making 54,000. And there's a transfer to general reserve, 8,000. Do you get it?
Yes.
So for your retained earnings, we have the profit for the year, which is 48,000. You add up with the balance, which is 41,000. You less 30,000, which was partly paid, and the interim, which was 24,000, and the transfer to general reserve. You add them together. You take it away from 98 from 89,000. So that's 89,000 minus 54 plus 8, that's 62,000. 62,000. So it's 27,000. So 27,000 is your retained profit. So the total amount, the balance will be 27,000, which is retained profit, plus 300,000 worth of shares, and the total amount of general reserve. That will give you the total capital involved. That will be the total capital.
Yeah.
Do you get it or not?
Yes.
So go to statement of financial position of a limited company. When you have to prepare the statement of changes in equity, what are they trying to say? They're just telling us that how do they share how has money changed from one place to another. So the items you're going to have the share, the ordinary share capital, you're going to have the reserve, the general reserve, and you're going to have the retained earnings.
Yeah, and
no, I'm talking about change in equity. So those are the three things you have. Then the items are the profit for the year, dividend paid, if there's final, dividend paid, if there's interim, the transfer to general profit, that's all.
And the statement of financial position, there is none.
No, I'm talking about the statement of change in equity.
Oh, yeah, I guess, yeah.
So now we go to statement of financial position. So they say in the statement of financial position of a limited company, the asset section and the current liability sections are presented in exactly the same way as for a sole trader or a partnership. So it's just the same way. But the non-current liability section may include redeemable preference shares, debentures, and any other non-current liabilities. So what makes it differ is that in the statement of financial position, you might have redeemable, non-redeemable, might have what's it called? You might have debentures. These are the things you have in your statement of financial position. Then the capital section has to be modified so that it shows the details of the shares and reserve of the company. The general reserve and the retained earnings are added to the share capital as the percent profit which has been retained in the company, and as such belong to the ordinary shareholders. So what you have to add is the retained profit and the general reserve. The retained profit from the retained profit and the general reserve. General reserve is 8,000. Transfer to general reserve. You put it has to be added to the capital. And the retained earnings, they represent the profit made by the firm. So they have to be in your statement of financial position because they are. Do you know what I'm saying? The general reserve from our changes in equity, statement of change in equity, we have transferred to general reserve as 8,000. Then we have our retained earnings. These two has to be in your statement of financial position because they represent the profit made by the business.
Yeah, we'll get to it and then we'll see.
Okay. With this, you understand it. This said, using the information and statement of change in equity provided, prepare an appropriate extract from the statement of financial position of Anand Limited at this. We have equity and liability. Ordinary share capital decided was 300,000. That's the what. The general reserve. The total of general reserve is 53,000.
Must be 8.
What?
It's not. Doesn't. I mean. It said here that's 8,000, but here it's 53,000.
Yeah, the total is 53. The balance from the general reserve was 45,000 plus the 8,000. There's a general reserve before.
Yeah. I get it.
You have a general reserve.
Yes.
The balance from the general reserve You had the transfer to the general reserve.
Yes, I get.
So that's 53,000. Then you had your retained earnings to it. So that's all about that.
But if there was the loan, that's the finance.
Equity and liabilities. Loan.
Yeah, the loan.
Yeah, if there is, you take it away.
Take it away from it, not add it.
Yeah, but there's no loan. If you have loans, you take it away from this. All these minus your loan.
And what if I have non?
Like debentures.
The debentures, we take it off. Non-redeemable purposes.
Non-redeemable.
Yes, we take it away.
Non-redeemable is a liability.
Yes.
It's a current liability.
Current, yeah.
Yeah. So you take it away, the liability, you take it away from your profit.
Yes.
In as much as you are taking debentures away, you have to take non-redeemable away too.
Yes, yes.
So this represents what the business owns now. So what the business owns minus what the business owes gives you your capital.
Oh, yes, yes, okay.
So we have questions. So which statement about debentures is correct?
B.
B, yes. Question 2. XZ Limited was formed on 1st of August 2021. Which time may appear in the statement of changes in equity? In the statement of changes in equity.
The next year.
Of changes in equity for the year ended.
D.
Was formed. It would have.
It has dividend paid. Ordinary share dividend paid. And yeah.
Okay, it's going to have ordinary share dividend paid.
Yes.
It's going to have.
Not proposed.
They will proposed. Ordinary share dividend proposed.
To have it.
Yeah.
So it's the CC.
And there will be a transfer to general reserve.
Yes, see.
Question 3. They said, I don't know the difference between the following.
Yeah, it's
it's long gone. Look at question 4. Which item are included in the equity section of the statement of financial position of the limited company?
So the financial, yeah.
They say which items are included in the equity section section
yeah.
of the statement of financial position of the limited company?
Info.
General reserve and ordinary shares. Yes. Rest are. Yes.
Good juice.
Okay.